All right, everybody. Thank you for joining me. For those of you that don't know me, my name is Ryan Melliker. I am president and co-founder of Lodging Analytics Research and Consulting, or LARC for short, as we like to refer to it. Before we get underway, I'm just going to highlight a couple of important topics for you all. Number one is this webinar is being recorded. If you have to jump off at any point, don't worry. If you want to share the recording with a friend, don't worry. We're going to post it on our website and we'll email it out later today or tomorrow morning for everybody. So you'll be able to catch anything that you may miss. Number two is I know we're going to get the question a dozen times, so I'm going to try to preempt it. We are going to send out the slides to those that attended the webinar, so you don't need to ask for them. You will receive them. And then the third thing that I'd like to highlight here is that we are going to do a Q&A session at the end of the presentation. So feel free to post your questions into the chat. I think you all probably know how the Q&A works um, within Zoom now. So go forward and take care of that. Katie Harding from my team is going to kind of manage the Q&A process and kind of consolidate questions. If for whatever reason we don't get to your question, my apologies up front. We will do our best to get to everything. Or if you want to ask a question offline, you're welcome to email me directly at ryan.melliker@larcanalytics.com. That's LARC, just like you see on the screen, analytics.com. Or you can email information@larcanalytics.com if that's easier for you. With that being said, we're going to jump in. There's a lot to get through today, a lot of different things going on. So I want to make sure that we give everybody enough time. So that being said, this is kind of our agenda. We're going to do a quick, brief overview of kind of how the industry's been performing. We're then going to spend a lot of time on the economic outlook and the implications, with really a focus on kind of four components. Number one is the current administration's policies and their impact on the hotel industry, and specifically the corporate, the leisure, and the group segments. Then we'll jump into our top line outlook, followed by our bottom line outlook and values, and then we'll touch on some market highlights, and then we'll go into Q&A. So with that being said, I'm going to go ahead and jump right in. Like I said, there's a lot of ground to cover. So first of all, when you think about recent performance, what I would highlight here, which I think is really important, is that when you think about the last 5 quarters of performance in the top line, supply, demand, occupancy, ADR, RevPAR, there's been a lot of noise in those quarters, right? First quarter 2024 had the tough Easter calendar shift. Second quarter 2024 had a couple of tailwinds, the benefit of the Easter calendar shift, as well as the solar eclipse. Then we had a really soft summer leisure season last year. And then in the fourth quarter, we saw really strong growth tied to a couple of things. One was disaster relief efforts in Texas and the Southeast. And number two was pent-up demand leading up the general election that got unleashed with the swift resolution of that election. And then as we went through the first quarter of 2025, the expectation was really that things would be stronger than they were. And that was partly driven by the Easter calendar shift again, which was going to create a bit more of a tailwind in March, as well as kind of continued pent-up the unleashing of pent-up demand from the general election. And what we saw throughout the first quarter was a gradual deceleration in RevPAR growth. January was up over 4%, February was up around 2%. Then March was up less than 1%, despite that positive Easter calendar shift. And then April, which had the tough comps from the solar eclipse and that Easter shift, was down 0.6%, and May's tracking roughly flattish. So that gives you kind of a look at kind of how things have progressed on the top line nationally. Now we can look at things nationally, but obviously we all know that we operate on a market by market basis. National benchmarks are helpful, but really matters to what markets you're really focused on, because there is a wide variance between market performance. The top chart here shows 2024 RevPAR growth across the 62 markets that we track, and the bottom is the first quarter of 2025 growth. And what you can see across the board is there's a wide variance. A market like Houston saw 15% RevPAR growth last year, heavily tied to that, hurricane relief efforts. Meanwhile, Maui was -10, right? And then even in the first quarter, just one quarter, markets like Palm Beach and San Francisco up 8%, while a market like Memphis down 6. So a lot of noise tied to some of these dynamics, and really trying to understand what drives individual markets as opposed to looking at things on a national holistic basis will be really helpful to everybody on this call. But for the most part, we're going to focus nationally here because I think that gives you kind of the benchmark, and then you can drill down to the specific markets, which is what we tend to do for our clients. So that being said, when we go back to kind of the national level, obviously you can see OKDR RevPAR there, but not surprisingly, expense growth outpaced RevPAR growth in 2024, and in the first quarter of 2025, and we've seen negative hotel EBITDA growth. Now, we also felt like values actually increased in 2024 despite that negative hotel EBITDA growth, and that's because the industry was getting a little bit more confident surrounding cutting rates. The recessionary fears went away. You saw an outlook that was much more promising as we moved through 2024, especially with the swift resolution of the general election. So we saw values actually rise modestly in 2024, which I think is interesting. Now, as we think about things going forward, I want to talk first and foremost about kind of the current administration's policies and the implications that we see on those policies. And I'd be remiss if I didn't start with tariffs, right? It's kind of the 800-pound gorilla in the room. What we think about the tariffs, obviously, look, the reality of the tariffs is twofold. One, tariffs imposed tariffs are likely to be lead to rising inflation and, a negative or a headwind for economic growth and business investment, plain and simple. That's not super positive, but that's not anything new and not super negative either. That's more on the margin. The real concern surrounding tariffs is not the tariffs themselves. It's the actual execution and imposition of the tariffs and how that's gone about doing and how that has occurred. At the end of the day, as I'm sure everybody here is very aware, the administration has generally taken a view of trying to negotiate tariffs in public with other foreign entities. And that has caused a tremendous amount of back and forth threats and the pulling back of those threats, all those types of things that have played out. This list that you see on the slide right here is just Mexico and Canada, and you can see how much things moved around back and forth. And at the end of the day, if you are a business that imports product from a foreign country, you are likely to be sitting there saying, I don't know what my tariffs are going to look like. I don't know how much my goods are going to cost in next week, next month, next year. Maybe I just need to pause and wait for this all to settle out. And that's exactly what has happened. Ultimately, corporations have stopped doing anything. We refer to it as a corporate paralysis. And on top of that, the media, is heavily scrutinizing the tariffs and the implications that's having on inflation, and that's leading to eroding consumer confidence. Now, the real question that I don't think anybody knows the answer to is how long will this uncertainty and this waffling on tariffs go back and forth? We don't really know the answer. I don't think anybody knows the answer. I don't think Trump knows the answer. But that obviously is going to continue to have an impact on what the economic outlook is. And until we have tremendous amount of clarity on that, it's hard to have tremendous amount of clarity on anything else related to the economy or even our forecast for the hotel industry. So just something to be mindful of. And when you look at kind of that tariff uncertainty, one of the things that we tried to highlight here is just how volatile the stock market became during kind of the peak of that uncertainty. You can see back and forth here. You can see the volatility index really, really spiked. We've since normalized, which is good, and hopefully it stays that way as the stock market at least has started to accept the dynamics of how things are unfolding. But while that's the truth, and that may not be a negative going forward, the reality is, if you look at some of the headlines for recently, if businesses don't know what economic policy is going to be, they freeze hiring, they pause investment, and they basically take a wait and see approach. This is a great headline from the Wall Street Journal just this past weekend that just kind of highlighted even Trump doesn't know what Trump will do next. And that's not a great sign for business confidence and the willingness to spend money, grow their platforms if they don't know what type of environment they're operating within. And that's translating into a challenge when it comes to corporate profits and business investment. So If you look at Moody's forecast for business investment, it's a dark blue line here. You can see it's expected to be negative in the second quarter and really stay negative into 2026. Meanwhile, corporate profits are expected to gradually, growth is going to decline, turn negative by the end of this year, and really stay negative through most of 2026. Why is this bad? Well, those are some of the primary drivers of corporate transient demand. If businesses are pulling back on their spending, they're going to pull back on their corporate travel. And that is a real concern that we are monitoring very, very closely. To give you an idea, if you look at business investment and absolute RevPAR, we're not even talking about corporate transient here, just overall RevPAR, going back 25 years, there's an 85% correlation between those two data sets for and a 72% R square. If you don't remember your R square from your stats class back in college, it's basically a causality measure, says that basically business investment drives 72% of all the variability of RevPAR historically over the past 25 years. Big, big factor, right? Not just, and that's not the only one. Corporate profits also is a large factor, not to the same extent, but a 75% correlation and a 57% R square. So again, if these things are pulling back in a meaningful way, it is not positive for corporate transient demand, and just something to be really, really mindful of as we come out of the summer. And paying close attention to how those metrics are starting to unfold. The outlooks from Moody's, the economists we rely on, are not encouraging in that front. Now, it's not just about business, it's also about the consumer. And when you think about the consumer, we were feeling, and we'll touch upon this a few times. We were feeling pretty good going into 2025 related to the consumer. In early 2024, sentiment had really, you know, fallen and bottomed in July. And then we started to see things start to rise. It actually rose 9% from July through November. Like, okay, this is actually encouraging. Things are starting to get better. Maybe it'll be a good summer leisure travel season. And then the tariff dynamic started to unfold. And consumer sentiment has since dropped 17%. Pretty big decline over the past few months. And again, this is heavily tied to the tariffs. It's largely tied to the media coverage of the tariffs, where from the consumer's perspective, when it comes to inflation, we would refer to it as a once bitten, twice shy dynamic, right? A couple of years ago, inflation was really bad. People were really frustrated. Cost of living was too high. They weren't making enough money. Really, really challenging environment for a lot of US consumers. So now when the media is talking about how policy is going to increase inflation, which we think it will, that has caused the consumer to get a little spooked. And therefore, you're seeing a bit of a retrenchment from the consumer, certainly from a sentiment and from some other metrics, which we'll touch upon in a few minutes. But at the end of the day, when you think about the economic policies of the administration, it's not all about the tariffs. There are other things that are also having an impact on the hotel industry. The rhetoric and foreign travel dynamic is very, very real. We're certainly seeing a dynamic where inbound foreign arrivals, which had been growing at a nice clip through 2024, are now down 3% this year. And on top of that, the Trump administration initiated a policy to restrict entry for citizens of 12 different countries, citing national security concerns. That's created a backlash from international communities and human rights organizations. And at the end of the day, it's added to anti-American sentiment. And when you have a negative when anti-American sentiment has increased across foreign countries, translates into less likelihood of inbound foreign arrivals. And that's the concern that we see today. That's certainly why we've seen kind of a shift year to date versus the trends we were seeing in 24, and why we're a little worried about how that will continue throughout the remainder of this year and into next year. To give you an idea, when you think about this is kind of fascinating data, if you ask me. If you go back to 2019, in 2019, the US was a net exporter of travelers, or I'm sorry, net importer of travelers. More foreign travelers came to the US than left the US, right? In US citizens going abroad was a smaller number than foreign travelers coming to the US, to the tune of about 4 million travelers, right? And that's what you see right here. But following the pandemic, that has done a full 180 in a very negative way and getting worse, right? On a trailing 12-month basis, as of April, we exported 15 million more travelers than we imported, right? So a net negative 15. That's a difference of +4 to -15, or a $19 million, 19 million traveler shift. And obviously, foreign travelers tend to stay longer, longer length of stay. So that 19 million actually has a bigger impact on room nights. And that is a concern. Now, going into the year, we were feeling pretty good. Hey, traveler volumes were increasing. They were up, inbound foreign arrivals were up 9% year over year. But as I mentioned, that has since turned. They're down 3% year to date through April. But international outbound U.S. citizens traveling abroad has not. It's moderated a little bit. It was up 8% year over year last year, but it's still positive, up 3% year over year this year. We had thought going into this year that those trends would actually be opposite, where we'd see more foreign inbound arrivals and less U.S. citizen outbound. And the reason behind that was because of the expectation for the falling dollar. As the dollar drops in value, U.S. destinations become less expensive for foreign travelers, and international destinations become more expensive for U.S. travelers. Same things. The opposite is the case when the dollar increases in value. Well, going into 2025, the expectation was the dollar was going to fall meaningfully in 2025 and 2026, creating a really nice tailwind. But what we've seen now is that the majority of 2025 is actually going to see an increase in value. According to Moody's, it will fall eventually, go below that 0%, and it'll be negative in 26 and 27. But at the end of the day, we don't have that super positive view on the strength of the dollar, on the softening of the dollar. And we certainly have the rhetoric dynamic that are both weighing heavily on the reality of foreign inbound arrivals. Now, not every market is impacted by foreign inbound travel in the same way. This just kind of gives you a nice chart of the exposure different markets have had historically to inbound foreign arrivals. You can see it shouldn't be too surprising. Markets like Miami, New York, Honolulu are at the top of this list. There's also LA, San Francisco that are high. Then there's kind of a big step down to some other markets, followed by a gradual reduction to markets at the lower end here that basically don't have much exposure at all. Understanding exposure of different markets is important and very relevant. It's not just the exposure that's relevant, it's also how far they've recovered or still have left to recover relative to pre-pandemic levels. And this is data for year to date through April 2019, where you can see a handful of markets have actually recovered and they're back well above pre-pandemic levels. Well, you still have markets like Honolulu that's 44% below pre-pandemic levels. So plenty of recovery remaining there. What we think is really interesting is you look at a market like Seattle that's 4% above 2019 levels, and then other West Coast markets, San Francisco's 8% below, LA 17% below. So Seattle's seen a big windfall. Whereas LA and San Francisco have not seen that full recovery yet, despite the fact that they're all on the West Coast and have large international presences. Another one that's kind of interesting to me is New York. We hear about New York and all the foreign inbound arrivals and all the foreign travelers that are staying in New York. It's still 11% below 2019 levels, so there's still plenty of upside there for New York. Just a couple things to keep in mind. Moving beyond that, I think it's also important to talk about immigration policy. Why does immigration policy matter? Well, it's real simple. If Trump has his way, and I'm not saying he will, or I'm not saying this is truly his way based on what he's said in the past, he wants to deport 15 to 20 million undocumented workers. It's a large number. And that would have a pretty big impact on overall economic activity because that's 15 to 20 million people that are spending money that are gone, and then they're not spending as much. Some of the data points to as much as 1.1 to 1.7 trillion dollars in economic losses. Importantly, so that's a concern that's worth that's worth paying attention to. The other thing that's going on here is what Trump has successfully done is he's really reduced the number of border crossings, especially at the southern border, where in February it was roughly 12,000, undocumented immigrants that crossed the border. Compare that to an average of about 190,000 per month in 2023 and 2024. Why does that matter? Well, according to several sources, there's about 1.1 million undocumented workers employed in the U.S. hospitality sector. Okay, so if you're having them being deported, coupled with fewer of them coming across to fill those roles, then what's going to happen as your labor pool shrinks, right? And now there's a lot of hotels that don't have undocumented workers, but there's also a lot of hotels that use contract labor, temp agencies, et cetera, that maybe they are using undocumented workers and they may not even know it. That's the big challenge. So when you think about markets that are reliant on undocumented workers, they tend to be more focused to Texas, California, Florida. It's very likely that that labor pool is going to shrink, and that's going to put upward pressure on wages to try to keep staff appropriately. The other thing that's going to happen with that is the construction industry also heavily relies on undocumented workers, and that's going to drive construction costs up. It's going to drive development timelines up, and it's going to drive renovation costs and renovation timelines up. So when you think about that, that has a couple of impacts. Number one, less development, right? So you won't see as much supply growth. That may be good for hotel owners and operators today, probably not great for the brands that are trying to grow. So they're going to be growing more through conversion than new build. Number two is if you're an existing if you own or operate an existing asset that's looking to go under renovation, that renovation is likely going to cost materially more than it may have a couple of years ago. Number one. Number two is it could take a lot longer, which means there's more disruption. So the economic impact of that renovation is greater. So a couple of things just be mindful of as we work through all this. And then the last thing that I'll talk about with regards to the administration's economic policies and policies in general is tied to federal employee layoffs. Through the first quarter, the Trump administration, with the help of DOGE, has laid off about 280,000 workers. It's about 15% of the federal workforce. They've also really cut costs and put a ton of pressure on government employees to cut costs, canceling credit cards, all kinds of dynamics like that. That has spurred a massive reduction in government-rated travel. And we think that government business continues to be really, really soft, facing heavy obstacles, not just over the next month or two, but really through the next year. So some challenges related to government business is very mindful. Some would argue, hey, there's some upside here as federal workers go back to the office. Why would there be upside from federal workers going back to the office? Well, when people are in the office more, you're more likely to see travelers go to visit them in the office. Corporate transient demand. Nobody goes to on a corporate transient. Hey, I'm going to go to. I'm traveling to Atlanta for a corporate meeting. Why don't I come to your living room? Right? It doesn't work that way. Always, if you're in the office, we can meet with you. If you're not, we can't. And that's generally a factor that really limits corporate transient demand coming out of the pandemic. So the idea that people will be coming back to the office, federal government workers will be coming back to the office, was expected to be could have been a good positive for demand to those workers. Unfortunately, the reality is we don't see that materializing. On the margin, things are improving, sure, but at the end of the day, there's a couple major obstacles for getting the federal employees fully back to the office. Number one is you have multiple union agreements that basically enable remote work 5 days a week. Number two is the DOGE terminated 10 million square feet of office leases, about 750 office leases. So, people that are supposed to go back to the office may not have an office to go back to, right? These are big factors that really limit those expectations. So while we would love to say that, hey, return to office is going to be a boon and going to offset the declines in the labor pool and the reduction in spending, it's not. We don't have that view at all. And it's not just about federal employee return to the office. Return to office has been kind of a theme for the past few years. And here's just a few headlines that we pulled over the past couple of months. The reality is you can find 10 to 15 headlines talking about return to office and how everything's stepping up. You can find it every month for the last 5 years, right? And while we've seen those headlines constantly, the data doesn't support that it's actually happening, right? This is data from Castle Systems. And what you will see is basically over the past 2 years, we've stabilized right around just above 50% of 2019 levels, right? And it's been a couple of years where we've been stable. You zoom in and just look at the last couple of months, and it's still right there. There's no real movement. At the end of the day, we are not seeing that movement. And it's not just from Castle Systems, which is one data source. We also rely on a company called the Flex Index. The Flex Index surveys over 100 million employees and 100,000 office locations. um, and on a quarterly basis. And what they basically estimate is that in the US, firms require employees to be in the office 2.82 days per week as of the second quarter, right? So currently, right? That's an uptick from 2 quarters ago of 2.78, so zero point zero 0.04. So not a lot of movement on the margin improvement. And a year earlier, it was about 2.5. So we have moved over the past year. But that movement is slowing, and we're not seeing anything near that, 4 days a week. This is a number that's likely to stabilize somewhere around three. And we're pretty close to that right now. So at the end of the day, if you're not getting people back to the office, corporate transient demand growth is going to be driven by business investment expansion, corporate profit expansion, not office utilization expansion. And if we're not seeing the office utilization expansion and those other factors are declining, that's going to put pressure on corporate transient demand. On top of that, when you think about the sectors that have the most flexibility, where people are in the office the least, well, that's technology, insurance, financial services, professional services, basically the sectors that drive the most corporate transient demand. So that's not great for the hotel industry either. Um, Moving beyond that, let's give you guys some good news now. Sorry, all the Debbie Downers. There is some really good news, and that's tied to the group segment. We continue to see a lot of strength in the group segment in 2024. And for those of you that don't know, we track the 30 largest convention centers across the US. We get the data directly from the convention center or the CVB or the DMO, aggregate that data here for you all. Our clients get access to all of the data um, on a location by location basis. So they break it down and can see things more granularly. But this is an aggregate. And what you can see in 2024, convention room nights increased 3% year over year across the US. That's positive. 2025, we're pacing up 5%, also positive. 2026, pacing up 7% year over year. So we've got some nice tailwinds from large group. Now, we do see softness tied to association business, government business. Small group is pausing a little bit, similar to corporate transient in terms of bookings as we look through this year. But those big groups are really, really strong. And that helps with pricing power. And it just helps the group segment in general, especially in core urban locations. But not every market's going to perform the same. We've got some massive growth in certain markets. San Francisco, Moscone Center is having a phenomenal year. Part of that is because last year was so bad. So the recovery is really strong this year. Orlando is also having a really good year, as is Charlotte. Meanwhile, markets like Atlanta, Austin, Minneapolis are having really soft years, so they face headwinds from convention calendars. Austin, as many of you probably know, the convention center closed after the first quarter, and they closed for about 5 years. It's going to weigh on their convention bookings over the next few years. Now, when we shift from group, let's go back to that leisure component. And we talked about consumer sentiment before and talked about how it was down and then improved in the back half of the year and has since fallen. Well, retail sales growth paints a very similar picture. And this is actual data on retail sales across the US, where basically numbers were pretty soft in the first half of last year, averaging about 0.1% month over month growth in retail sales. That's soft for the consumer. That led to a really soft summer for leisure demand, as I'm sure most of you are really aware. But then we started to feel good about where things were going when you looked at how things started to improve in the back end of the year. We actually saw growth really pick up 0.6% in the back half of the year on a month over month basis. But then the new year hit, and January was negative meaningfully. February was flat. April was flat. March was positive in a big way, but that was largely tied to the pull forward of future demand related to pending tariff increases. So it wasn't necessarily a real number. And when you take an average of all of those things, we're looking at flattish retail sales growth. You exclude that March number that we know is elevated, and we're negative. And that's the concern that we have right now going into the summer leisure season, is that sentiment has pulled back, and so has and retail sales growth. And what we're seeing from the consumer is soft. And it's not just retail sales growth. The Visa Spending Index paints a very similar picture. This dark blue line, which is the aggregate spending index, you can see kind of declined through the summer and then started to rally again. We were feeling good going into 2025. It has since pulled back. The discretionary spending index tells a very similar story. It started to rally a little bit earlier. It's held up a little bit better. But again, we think that's tied to the pull forward of demand related to the tariffs in March. We pull that out. We don't think you're going to see those metrics. It's pulling back, going forward. And then when you look at the Deloitte Consumer Spending Intentions Index, which is forward-looking data, what you see here, overall spending, really bottomed in April, May of 2024, a couple months before that summer leisure season, and then started to rally going into the full year, going into the 2025, and has since pulled back. And then the same thing for the leisure specific, where you see it bottoming, in early 2024, a few months before the summer leisure travel season, started to rally, making things look strong heading into 2025, and has since moderated pretty meaningfully. We're now seeing a little bit of a bounce back, which is encouraging, but we're not sold that that's creating a trend just yet. Now, I'd be remiss if I didn't, explain the obvious, but believe it or not, when people save more, they spend less. When people spend less, they save more, right? Imagine that. At the end of the day, when we look, one of the things that we look at is the U.S. personal savings rate and the forecast from Moody's for U.S. personal savings rate, because there's a negative 86% correlation between how much people save and the share of their wallet they allocate to restaurants and hotels, plain and simple. So when we see savings rates increasing, that's not a positive for the hotel industry. When we see them decreasing, it tends to be a positive for the hotel industry. Well, if you look over the next few years, general theme is it's rising. We're going to see a little blip here of it falling, but we think that's largely tied to recession fears that we're, right now, where there's been a lot of layoffs and people are generally just saving. I'm sorry, people don't have as much to save, right? So with the layoffs, coupled with not having as much to save, you're just seeing that translate into not necessarily a more spend, it's just less savings. Whereas going forward, we think it's a combination of more savings translates into less spend. It's just something to keep in mind, keeps us a little bit more conservative in the near term on leisure travel. When you think about the broader economic outlook from Moody's that drives a lot of our forecasts, real GDP, just 1.3% growth this year, 1.5 next year, 2.1 in 2027. Notice there is not a recession forecast here. This is very, very muted growth, but no recession. Job growth, on the other hand, basically goes to flat in the back half of this year and really stays there into 2027. So really, really muted job growth. As a result, employment rates ticking up. Inflation is expected to be elevated this year, but then start to moderate next year and the year after. Corporate profits, we talked about that being negative this year. It'll be positive next year and the year after. Consumer confidence, we talked about as well. Foreign exchange rates turning negative later this year. And we expect it to stay negative really through into 2027. And then the 10-year Treasury yield will hover right around 4%, just over 4%. Now, I'd be remiss if I didn't talk about, the relationship between GDP and RevPAR. If you go back in time, we've always thought that RevPAR and GDP had a very strong relationship. And the reality is it has historically had a very strong relationship. Going back from 2000 to 2019, there's an 80% correlation and a 63% R squared. Generally speaking, when GDP growth was stronger, RevPAR growth was stronger. When GDP growth was weaker, RevPAR growth was weaker. Plain and simple. However, over the past 9 quarters, that relationship has really decoupled. We've got a negative 21% correlation, just a 4% R squared. So what's changed over the past 9 quarters that's translated into that relationship breaking down? I think it's really twofold. Number one is we have far less corporate transient demand than we've had before. With the office utilization levels at lower dynamics, you're not seeing the commercial activity that's driving, the activity that's driving GDP higher from a commercial perspective isn't translating to the same level of corporate demand that we've historically seen. Which obviously weighs on RevPAR growth relative to GDP growth. The other side of it that I think is really important is the international mix has shifted, right? We used to be a net importer of travelers. Now we're a net exporter of travelers, which means the consumer that's contributing to that GDP growth is choosing to spend their money abroad rather than domestically. So it does not impact RevPAR growth the way it has historically. So those are some of the things that we think have led to a big shift in this relationship. I don't think we get back to these levels anytime soon. And that's largely because we don't think the corporate dynamic really changes anytime soon. But we do think we probably, get closer to them than we are right now. So just something to keep in mind that GDP growth, while we all like to talk about it and the concerns around GDP growth being a big headwind right now for the industry, which it is, it's not the end all be all like I would have said it was 10 years ago. We've really seen a decoupling here. Now, as we think about our US outlook, I just want to highlight a few things here. Number one is some of our core assumptions from Moody's. The Fed's going to cut rates beginning next month, 25 basis points a quarter. Inflation is going to resume moderation next year. The conflicts in the Ukraine and Middle East will not escalate. And there's no near-term recession, but economic growth is going to be muted. Now, with that, let's talk about the lodging forecast, which I know everybody really wants to get deeper into. So, first of all that backdrop that I just talked about kind of frames our views on the core demand segments across the hotel industry. When we think about corporate transient demand, our general view, if you look at the dark blue line here, that's corporate transient. We expect a slight moderation in corporate transient demand in 2025 and 2026, and it stabilizes right around 10% below where it was in 2019 levels. Group demand, on the flip side, the light blue here, actually is picking up in 25 and 26, and then stabilizing right around 5% above where it was in 2019 levels. And leisure demand is kind of the big volatile one where we saw things out of the pandemic really boom. It's been moderating ever since. We expect a slight pullback this year, but then we see some growth next year. Part of that's tied to the World Cup, which we'll talk about in a little bit, and then some moderation in 2027 before we get things stabilizing around 15% above 2019 levels. So when we look at things relative to 2024, group is the winner in 25 and 26. Leisure will do a little better than corporate, down a little in 25, but then up in 2026. And corporate is going to remain lackluster. And when we think about things relative to pre-pandemic, leisure is the clear winner, stabilizing 15% above where things were pre-pandemic, followed by group, which is probably 5% above where it was pre-pandemic. And the loser here is corporate transient, which continues to struggle to recover to the level it was before. Now, when we talk about supply growth, which is always something we talk about with clients in great detail, and we do a ton of work on supply. Our team busts their butt every quarter, making sure our supply data is as accurate as it can be. What you'll see here is that we generally view supply growth as pretty benign across the country. Over the next 5 years, we do see it ticking up ever so slightly in 25 and 26, based on projects under construction today. But again, this is marginal. National averages over time have been just under 2% supply growth. So we're looking at less than 1% in any given year. Our CAGR over 5 years is just 0.7%. So we've got a really, really benign supply growth outlook. That's good for hotel owners, good for hotel operators, not as great for the brands that are trying to grow, which is why conversions become a bigger focus for the brands. Interestingly, if you look at the markets themselves, there's no market that has a ton of supply growth right now, right? We look at the 5-year compound annual growth rates, and there's nothing over 2.5%. Really, really muted factors. Meanwhile, you've got a bunch of markets that have very, very, very limited supply growth. And all of that's pretty encouraging. It kind of points to, hey, supply isn't a primary factor driving our views on any given market, positive or negative. It's just too muted to have a huge impact. And to us, we think that's a good thing for the industry. Obviously, developers would like to be able to develop more easily, and brands want to see more development to drive their brand growth. But at the end of the day, for the industry as a whole, this is a nice tailwind. Now, when you think about our RevPAR forecast, for those of you that haven't seen our work, we build out multivariate linear regression forecast models to try to understand what factors, what macroeconomic factors have driven RevPAR historically, and then which ones will drive them going forward. What you see in this chart here in the dark blue line is actual RevPAR as reported by CoStar on a seasonally adjusted basis going back to 2000. And in a light blue line is the model that we've built to forecast that RevPAR historically as well as going forward. We forecast that RevPAR primarily using these metrics. We have a few others, but these are the main ones. And historically, that model has a 98.8% R squared, so highly accurate historically. And then based on Moody's forecast for these metrics, you get the forecast for RevPAR growth. You will notice kind of this little hump here in 2026. That's tied to the World Cup, which we're going to talk about in a minute. But I think it's important to highlight. Same thing for ADR. Dark blue line is the actuals. Light blue line is our model. Again, very high R squared, 98.9%. Drivers are a little different, but you get the idea. Now, we put it all together. Here you can see our occupancy for 2025 is 62.5%, which is down about 50 bips from where it was in 2024. We are forecasting a 2.1% ADR growth this year and a 1.3% RevPAR growth. Pretty much every forecaster that you see here is in relatively the same ballpark between 0.9 and 1.3. And I'm going to tell you a little secret. None of us have any idea. Why do we have no idea? Because we don't know what economic policy is going to be in 3 days, let alone 3 months. And if we don't know what economic policy is going to be, it makes it really hard to actually forecast what the industry is going to do. So that's why we've actually built in some sense, some bull case and bear case scenarios, which we'll walk you guys through in a minute. That being said, based on the backdrop that I just shared with you and the economic forecast from Moody's, our models tell us 1.3% RevPAR growth in 2025, and then a bit of an acceleration in 2026 to 1.9%. The other thing I'll tell you is our forecasts are higher than everybody else for ADR in 25 and 26 and lower than everybody else for occupancy in 25 and 26. We tend to be much more conservative on the occupancy side and a little bit more aggressive on ADR. That's proven to be the right call over the past few years. We'll see how it unfolds in 2025. Moving beyond the annual forecast, let's drill into the quarters. We talked a little bit earlier about the headwinds and tailwinds in 2024 that kind of shaped the outlook for 2025, right? 2Q faced some soft comps. I'm sorry, 1Q 2025 faced some soft comps in March, but that didn't really translate into better growth. 2Q faces tougher comps, and that's why April was negative. We expect an acceleration in RevPAR growth in June. We will see if that plays out, but we still are forecasting negative occupancy. And then as we move through the year, 3Q, we think has a little bit better performance tied to a soft leisure period last summer. And then we see things turning negative in 2025 on really difficult comps following the national disaster relief and the pent-up demand from the general election. And then as we move into 2026, we see a lot of strength over the summer. That's the World Cup before RevPAR growth goes negative in the fourth quarter. And we'll talk about that in a minute. And then before we jump into the World Cup, I just want to break down real quickly the chain scale forecasts. And what I want to highlight about the chain scale forecasts is these are national chain scale metrics, right? At the end of the day, we are not of the belief that, hey, a Courtyard by Marriott is always going to outperform the full service Marriott. Hilton Garden is always going to underperform the Hilton, right? That is not our view. I think this is more driven by demand segment mix, and location mix than anything else. At the end of the day, we are big believers that over the next couple of years, group is going to be the winner. If you're a select service hotel adjacent to a convention center with a strong booking pace, you're going to do way better than a full service hotel in the suburbs that doesn't have a strong group booking pace, right? Understanding those dynamics is really important. This is helpful when you get a kind of that frame, the national reference, and certainly relevant to larger brands and whatnot that have a swath of coverage. But when you're looking at individual assets, individual portfolios, delineating those factors is really helpful. But at the end of the day, we continue to believe the high end is going to outperform and the low end is going to underperform. This is consistent with how we viewed things over the past couple of years, and we see that playing out. And it's heavily driven by our view on where group demand is going, especially from a convention perspective. Now, let's talk about the World Cup. We get a ton of questions on the World Cup, and I want to make sure that we touch upon it because it's really important. Our intern actually put together the headline here, which I really like because it really is a different playing field. At the end of the day, the World Cup in the US is going to be very different from what we've seen from past World Cups, really ever. It's going to be held across 16 cities and 3 countries. The distance between the 2 cities farthest apart, the 2 stadiums farthest apart, is 4,800 kilometers. Compare that to Qatar, where the distance was 55 kilometers between the 2 farthest apart stadiums. It's a massive difference, right? What that creates is a lot of friction for fans that say, hey, am I really going to fly to Seattle to see a game and then stick around for 5 days and hang out? before the next game, or am I going to fly to Seattle and then turn around and fly to Kansas City the next day to see another match, and then fly to Dallas to see another match, right? You're running into these challenges where it's not just an hour train ride or an easy back and forth. So what that translates into is fans are less likely to visit host cities that they don't want to go to begin with. So we look at the cities that are going to see the best impact are going to be the ones that have a lot of international tourism already. And those that don't get a lot of international tourism probably aren't going to have that much of a lift. Um, and that's the reality. The other thing that's really unique about this time around versus past is number one, we have an administration that has not proved welcoming to a lot of foreign travelers. We have a anti-American sentiment overseas that's going to weigh on the desire to come travel to the U.S., even to support their own teams. And on top of that, you have a softer consumer, not just in the U.S., but nationally, sluggish economic growth that's going to weigh on the ability of travelers to go spend the money to come to the US for the World Cup. And let's talk about the ability to spend the money because I think it's important. So we don't think there's a really good comp for the World Cup in the US. The closest one that we have found is Russia in 2018, which had 12 cities across basically Russia, European Russia hosting, and the distance was 2,300 kilometers between the farthest south and the farthest north. So it's a meaningful distance, but it's not 4,800 kilometers, right? It's half the distance. And some cities are closer than others. So you have some different dynamics there, but it is relatively comparable. However, there's a huge, big difference. Actual room nights sold in Russia, according to CoStar, is about 3% of that of the US, which means the World Cup has a much bigger impact on a market that's that much smaller than the US, right? And Russia actually has an ADR level that's 23% below the US. So you're looking at a dynamic here where Russia, we refer to it as a best case benchmark. It's probably an unrealistic best case benchmark, way above what's likely to play out. But it's kind of at least a benchmark that we can gauge how numbers will play out. And as we look at that, what you will see across the different cities is a very different result. And we looked at we annualized what the impact of the World Cup was. And in Moscow, it was really, really meaningful. Moscow hosted the championship. New York going to host the championship next year. Moscow is a city that people want to go to, the culture, the history, all those dynamics. Meanwhile, St. Petersburg actually had no impact, super negative. People chose to avoid St. Petersburg during the World Cup periods. And then some of the other markets, Ekaterinburg, Sochi, some of the submarkets across Russia, regional Europe, saw modest growth, right? Modest impact. At the end of the day, it's not going to be the same across markets. Overall, across Russia, we estimate that there was close to a 7% impact. But again, 7% on 97% less demand than the US has. So that is a real challenge. We think top tier markets like New York, LA, Miami will see some lift. And that's going to be really encouraging. We're less confident in places like Kansas City, Boston, Philadelphia, that just are less likely to see a tremendous amount of demand. Also, Dallas and Atlanta host the semifinals, so they're likely to see a pop, which is encouraging for them. Overall, we estimate that US will experience somewhere around 2%, maybe 3% tailwind from the World Cup in 2026. So that's positive, right? Hey, that's nice growth. Woohoo! Positive, great. We're certainly not negative on it, just not this 7% that Russia saw or this 15+% that Moscow saw, and it certainly isn't across every market that's hosting. We do see a lift. Now, the caveat here is our U.S. forecasted RevPAR growth for 2026, like I mentioned before, is only 1.9% growth. If we have 1.9% growth and we're looking at 2 to 3% lift from the World Cup, what does that say about every other city that's not hosting the World Cup? That's a concern that we have. We think 2026 is going to be a soft year in general, but there are going to be certain markets that outperform, and that national average is going to be elevated, tied to the benefit from the World Cup. And then in 2027, nationally, we see the difficult comp from the World Cup and things pulling back. Meanwhile, there's going to be a lot of markets that actually perform way better than that because they don't have that World Cup comparison. So, again, this comes back to that dynamic of, but as you guys look at markets and look at where your assets are, focus less about national benchmarks and more about what's happening in your market, because sometimes the national benchmarks can get really skewed, and that's exactly what we're going to see over the next couple of years. So just be mindful of that. I told you we had some scenarios that I wanted to highlight. I'm going to walk through a couple quick scenarios here. We actually provided an upside scenario and a downside scenario in our US forecast this quarter. The upside scenario basically is what you see here, where it basically assumes that, hey, things are way better than expected. Trump is going to wake up tomorrow and tweet out he's done with the tariffs and everything's going to skyrocket, right? Really positive. It's all good. Business uncertainty goes away. Consumer confidence improves, and you see strong rally into the year with 3.7% RevPAR growth and ADR up 9.5. Notice even in that scenario, we still have occupancy basically flat year over year this year before it starts to grow next year. Then there's the downside scenario. The downside scenario assumes there is a recession this year, that the uncertainty tied to the tariffs continues on. We continue to see more waffling. Tomorrow Trump tweets, okay, the EU's 50% tariff is back on, and then maybe a couple of days later, no, it's not. We've seen that. We've seen that, that movie before, right? So that weighs on RevPAR growth, which continues to decline as we move through this year, and creates some real softness in the fourth quarter and the first quarter before we start to lap some of those softer comps. We see the World Cup dynamic benefiting second and third quarter, but RevPAR is still slightly negative in 2026. That is the downside scenario. Now, when we think about our forecast, I'm going to fly through this, but our general view is better data in equals better data out. We think that's really, really important in terms of how we forecast. I think it's staggering to me that the other forecasters out there don't incorporate convention pacing data when they're forecasting for individual markets. We think that's really, really important, has a big factor in driving that. You can see some of the other data providers that we use, because we think it's really important to not only be transparent about who we use, but why we use them, because we've chosen what we believe are the best data providers across the industry. And that's translated into, generally speaking, better forecasting. So if you look, where was our forecast for 2024 at the start of the year versus the actual results at the end of the year, we missed by 60 basis points on RevPAR. Nobody else was within 1 percentage point. If you think 2024 was an anomaly, you'd be wrong. We were the most accurate in 21. We were the most accurate in 22. In 2023, we were not the most accurate. We give that credit to PwC. They were the only forecaster within 1% of both occupancy and of occupancy, ADR, and RevPAR, but only us and them were within 1% of occupancy and ADR. And it's not just at the national level. At a market level, we've proven to be more accurate than the leading providers in over 70% of our markets. In 2024, we were more accurate. Importantly, we're more accurate by a wide margin in most of these cases, and in some cases by a really, really wide margin. And that's really encouraging to us. It's one of the reasons why we work with so many clients who love the work that we do. And just to give you an idea, whether you're looking 1 year out, 2 years out, or 3 years out, we outperform. In fact, on a 1 year out basis, we're more accurate than other guys in 80% of the top 25 markets, 70% of our overall markets. So we think that helped, that forecast accuracy has given our clients a lot of confidence, and hopefully should give you guys some confidence in terms of how we think about the US and how we think about the markets. Now let's move beyond the top line. I think I'd be remiss if we didn't talk about labor costs, which is the 800-pound gorilla in the room that we're really focused on right now. When you think about labor, generally speaking, union wages are a huge issue across a lot of major cities, especially gateway cities. New York is coming next year, which is a big concern. We generally think these benchmarks are indicative of what we'll probably see in New York. And we also think that the impact from union hotels, union negotiations, are going to impact not just union hotels, but also non-union hotels, because the whole purpose of being non-union is to avoid the work rules, which are the biggest limitation, which means you pay more to try to avoid unionization. So union pays here, you pay here. And then what happens when the union goes here? You go here. So it impacts everybody. And it's not just about union issues. We're also seeing political environment that's very challenging. In Los Angeles, we saw a minimum wage. It's going to increase to $30 by 2028. Massive increase there. And in New York, they passed the Safe Hotels Act that went into effect on May 3rd, which basically eliminates the ability to use contract labor for any hotel over 60 rooms. That's going to have a huge impact on non-union hotels that are now basically forced to unionize. So that's a concern in those two cities. But at the end of the day, we are generally concerned about these types of things spreading beyond New York and LA. Do we forecast, them to spread to other cities? We don't. But would it surprise us if we woke up tomorrow morning and a Safe Hotels Act was proposed in San Francisco? Absolutely not. We think we'll see it across. We think there's risk to seeing these things across a lot of other markets. Put it all together, we've got property taxes rising, wages continuing to increase modestly, insurance remains elevated, other expenses will continue to grow, and we've got overall expenses increasing about 3% this year and next year. They decline in 2027, but that's tied to negative occupancy growth, followed by growth in 2028 and 2029. And importantly, we continue to see EBITDA declining through 2027. We don't see positive EBITDA growth across the industry until 2028, which obviously isn't anything exciting. I'm sorry to not point to more positivity there, but I think that the wage growth dynamic is really, really important from a national perspective. And then we're moving on to valuation. Here's our cap rate model. I don't need to belabor the point. I walked through the other models before, and it basically, and then here's what the forecasts generally look like, where we talked about EBITDA being down 2% this year. We've got values down this year as a result. Over the next 5 years, we see RevPAR up 1.6. That's basically just enough to offset expense growth. So you see flat EBITDA, but that EBITDA growth picks up towards those later years, as we talked about. So values start to accelerate based on a more positive outlook for cash flow growth. And we see values improving in the out years. And they're up, modest increases over the next 5 years. How has our forecast changed from last quarter? I think the big answer here is it's gotten much more cautious because the economic outlook has gotten much more tranquil. And we talked about that earlier on, how things have shifted over the past few months. I don't need to belabor that point, but we are much more cautious than we were just a few months ago. From a value perspective, the one thing I'd highlight here is that following the great financial crisis, we saw a lot of growth in the later years of the cycle. We don't forecast that here. The big difference is the macro outlook coupled with interest rate outlook. Interest rates are higher, expected to be higher for longer than we saw here, and the macro outlook is a little bit more sanguine. Now let's talk about some markets. These are the 62 markets we issue quarterly forecasts for. Left-hand side of the page are our standard reports. Right-hand side of the page are smaller markets where we issue truncated reports focused on the top line, supply, demand, occupancy, ADR, RevPAR. Across all 62 of those markets, you can see where our forecasts are for 2025 here. Strongest growth tends to be in markets with outsized economic growth and those that have strong convention paces. Softer growth tends to be in markets that generally are corporate transient oriented, have soft booking paces or really tough comps. Houston has that natural disaster relief comp, which brings them down. But you get a general sense of where some of those markets are. If we look out longer term, take a 5-year view, top performers either have really soft comps from 2024, like Maui and Orlando. They're strong markets going through major shifts, adding demand. Palm Beach is adding a corporate segment. So is Sedona. Raleigh's going through a convention center expansion. Great corporate relocations downtown, coupled with a great level of base demand. We think that's really strong. Puerto Rico and Miami have really strong economic trends, and then really robust convention calendars in markets like Orlando and New Orleans will drive those markets. Whereas bottom performers, you've got basically really sluggish economic growth in some of those smaller Midwestern cities. Soft convention calendars in Austin and Dallas, which are going under the knife, as everybody knows. And then outsized leisure exposure is going to weigh on a market like New York over the next 5 years. There's obviously going to be, I think, a really positive pop in 2026 there. And then tough comps tied to Houston. Again, I mentioned that before. And then when we look at values over the next 5 years, we love New Orleans, great convention calendar, modest expense growth. The new convention center entertainment complex is going to be amazing. We have the Orlando is one we really like, with the Epic Universe coupled with the convention calendar being really strong. The new sports complex downtown, all really positive. Puerto Rico. The energy infrastructure is amazing. And one of the things that you'll notice about the trend between those markets that we really like in the top five and those we don't like so much in the bottom five is cost structure and wage growth, right? These are all markets with better cost structures and lower wage growth over the next few years. And these are all markets with worse cost structures and higher wage growth over the next few years. We generally think that's a big factor in determining value appreciation over the next few years, given the outlook from the macro environment that drives our top line forecasts. And then for those of you that don't know what we do at LARC, we issue quarterly market intelligence reports. We also have a GIS application that you can kind of dig into, a web-based application, pull data forecasts for the area around any hotel in the country, basically select a hotel, draw an area around it, extract all kinds of data and forecasts for that area. And then we do a ton of advisory services. And for those of you that stuck around to the end, there is a bonus for you. You can now visit our e-store, larkanalytics.com/shop, which you see right here. You can purchase any of our reports directly there. And if you enter the coupon code webinar50 when you check out, you'll get 50% off your first report purchase between now and June 30th. So don't forget to tune it to stop there and purchase your reports, especially as we head into budgeting season. And with that, it is time for me to take questions. I know we went long. I'm sorry. I went as fast as I can. There was a lot to cover. Katie, how are we looking?
Alrighty, we don't have a ton, but we have
Great.
six, and I don't think we got any questions about the PowerPoint being sent this time, so it
Okay.
worked. Your announcement worked. Do you have the figures that show the change for US outbound versus international inbound travel? Trying to understand if there was less domestic travel as people decided to travel internationally instead. Thank you.
So you're wondering about, the outbound international versus inbound international? I
For
think
US outbound versus international inbound.
that's kind of what we showed back here. I'll get there eventually. There it is. There you go. Oop, went too far. There's the data there. We've seen a massive shift in foreign inbound versus domestic outbound, to the tune of 19 million travelers from 2019 versus the trailing 12 month through April. Kind of highlighted that here. If we're misunderstanding your question, just shoot us an email and try to answer it more clearly. But I think that's what you were looking for.
Are you factoring in any future impact from the big, beautiful bill being worked in Congress currently?
Yeah, I mean, I think in short, yes. If you go back to some of the scenario analysis that we highlight, we make it pretty clear that we are assuming that the big, beautiful bill generally goes through. We mention it here. Where are we? Not there. Here, full extension of tax cuts from and Jobs Act, personal income provisions, all those things. In the bull case scenario, we also incorporate an expansion of some of those things, whereas in the bear case scenario, we do not. But in all of these scenarios, the bull, the base, and the bear, we assume the Tax Cuts and Job Act gets extended. Plain and simple. It's just about whether we actually see the corporate tax rates change meaningfully or not.
Can you also share some details on how you forecast occupancy?
Sure. So plain and simple, when you think about our forecast, and I can go probably the best place to look at it is here in our quarterly forecasts. There we go. So at the end of the day, we believe that occupancy, ADR, and RevPAR are three variables that kind of tie together, right? Occupancy and ADR create RevPAR, or RevPAR and ADR can create occupancy, or RevPAR and occupancy can create RevPAR, right? The three variables are all linked. If you want the three variables to align, that means you can forecast for two of them and back into the third. Makes sense, right? We think the most important metric to forecast for is RevPAR from a statistical perspective, because that's the most important metric. So we build our statistical modeling around RevPAR and ADR and back into occupancy as a result. And then we
What's
also
your
layer in supply, which obviously drives our ADR and RevPAR models.
Alrighty. What's your view on extended stay?
We think extended stay is a great business, if it's true extended stay. I think that one of the challenges that we see across the hotel industry is many, quote, extended stay products are not extended stay. They tend to be more 2 to 3 night length of stay averages, not 20 to 30. and that creates an interesting dynamic where it's basically just a transient hotel with a kitchen. And then it's going to generally perform similar to other transient hotels. Maybe it's a better cost structure depending on what brand and kind of some of the amenities and creature comforts that it offers, but it's largely transient. True extended stay business is much more operationally intensive, more sales focused, but we think has a lot of legs. As you see more and more kind of life changes, more people willing to relocate for jobs, all the different dynamics that we see unfolding as our economy gets more and more intertwined from one market to another, one state to another, et cetera. And that's positive for extended stay over the long term.
How do you think Dallas will perform with the World Cup?
Dallas will be good because it's hosting a semifinals. If it weren't hosting the semifinals, we'd be far less positive about Dallas. But with the semifinals, we think that's going to be a boon in the third quarter of 2026.
Over the next 10 years, what ranges do you forecast for growth? Checking reasonableness of DCF forecasts. If you can, please comment across the spectrum of hotel scales and locations.
I think that we kind of walk through the scales in our forecast for 25 and 26, as well as our national forecast for 25 and 26 here. We do give a kind of aggregate in kind of 5-year outlook that we share towards the end here. There it is, where you can see kind of that 5-year CAGR on some of those metrics. If you're looking for more detail, I'd encourage you to purchase our US report.
Re-return to office, are there markets that are notably leading, an example, New York, and others that are lagging, impacting hotel demand?
I think generally what we would say is those markets that have a longer commute time are generally having more headwinds tied to return to office, whereas those markets that have less traffic or better public transit, generally don't have the same commuting challenges, have recovered much more sharply. So to give you an idea, a market like Dallas, which obviously, is a very vehicle-driven market, has recovered very dramatically from a return to office, whereas a market like DC, which has much worse traffic than Dallas and has public transit to try to offset that, has not recovered to the same extent.
Do LARC RevPAR growth forecasts at a market level take local supply increases into account?
100% they do. So we spend a lot of time on supply. Our team works really hard verifying every hotel under construction every quarter, and their opening dates, and that all gets factored into our forecasts.
Are you seeing any slowdown in pacing data for the summer? I've heard that bookings have softened as leisure travel slows down.
Yeah, our expectation is a relatively muted summer. It's not terrible because again, last summer was really, really soft. But we don't see a lot of growth from an occupancy perspective. The question is going to be whether the industry can try to hold rate a little bit.
What is the assumption for government per diem rates, fiscal year 2026?
So we don't have a specific assumption tied to government per diem rates. We don't put government per diem into a driver of our models. But what I can tell you is that we expect nominal increases, similar to what we've seen in past years.
Please clarify the reasoning behind your leisure group forecast. The chart appeared to show a better picture than your forecast.
I think the reasoning was everything that we walked through from a macro perspective, where right now, from a leisure dynamic, we are a little concerned surrounding where the consumer is. That's going to weigh on leisure growth going forward. There will be some tailwinds in 2026 tied to the World Cup, followed by headwinds the year that follows with the comp against the World Cup. But net, we see leisure as a winner relative to pre-pandemic levels. Group, we have some pretty strong numbers built in. Our convention pacing data is +5% this year, +7% next year. We really don't have any negative metrics going forward. Every year is kind of flat or positive through 2029, which is pretty encouraging to us. We estimate that that's going to help drive our group perspective overall. We think we are seeing some softness related to association business, government group, and kind of small group business that you normally would like to see booking 3 months out right now. That's taking the same wait and see approach that corporate transient is, and that will limit some of that growth in 2025 and potentially early 2026. But the big group business is still really strong.
On the 5-year value CAGRs, what kind of investment rate assumptions are being used? Does that assume minimal cap rate compression?
It does assume minimal cap rate compression, actually assumes cap rate expansion. At the end of the day, when we think, so our forecast, our values are driven by a forward DCF. So we're taking a look at kind of where cash flows are today and where they're going to be down the road, and then the 5-year forecast, right, for where they are. And then the discount rate is driven by the cap rate assumptions plus the growth profile. Cap rate assumptions, as we showed you, we build a model for cap rates to help drive our outlook for values. That's what you can see right here. And at the end of the day, if base rates, you can talk about the Fed cutting rates all we want. Typically, when the Fed cuts rates, they're cutting rates because there's economic softness, and that usually means spreads widen, right? So base rates go down, but spreads widen, and as a result, in that environment, we talked about the Fed expected to cut rates over the next, beginning in July for the next few quarters. And that's the underlying assumption, but take a look at what that does to our 10-year Treasury yield it's actually ticking up ever so slightly, right? So the Fed cutting rates doesn't necessarily translate into a reduction in cap rates for hotels. Well, the bigger factor is what's going on with 10-year Treasuries or BAA bond yields, because those factors take into account other components. We don't see those base rates declining over the next couple of years. And while the Fed is cutting rates and those base rates aren't declining, but the economic growth is contracting, and there's greater risk to that economic growth, spreads expand, and thus we see a modest uptick in cap rates, despite the fact that the Fed is cutting rates.
What do you feel of the impact of World Cup in Seattle?
I think it's hard to answer that question because we don't know which countries are going to be playing in Seattle. I can tell you if we see Asian countries, say, South Korea or China or Japan in Seattle, you're likely to see a big positive in Seattle. If it's going to be Zimbabwe and Kazakhstan and Croatia, I'm less confident. Again, I think a lot of it comes down to, is this a market where there's a lot of international tourism demand? And if the answer is yes, then the market should do really well. If the answer is no, then it's going to be a lot harder. And for Seattle, I think the access to the Asian markets is going to be a big factor, right? It's a lot easier and a lot more interesting for Asian countries where there's a large Asian population in Seattle to want to travel to Seattle. Less so for African countries or South American countries or Asia, Central Europe, right? So we don't really know yet. It's hard to have a strong view on Seattle. We can tell you we have markets that we have a strong view on, and that's LA, Miami, Dallas, Atlanta, New York that we think will all perform pretty well. And then there's markets that we think won't perform very well, like Philadelphia, Boston, Kansas City. Seattle is one of those that it remains to be seen, and a lot of it we think is going to come down to who's in the groups that play there.
Outlook on markets with convention centers going under multi-year renovations, specifically Austin, Texas.
Yeah, it's soft. We kind of highlight our Austin outlook, which is pretty muted. We build their convention pacing data into our forecast. And when you think about things from a top line perspective for Austin, it is very, very muted. So Austin is down here in terms of RevPAR growth on a 5-year CAGR 2024 through 2029. We're pretty soft.
It will help if you forecast per state. There are 50 states in the country, hopefully in the future. Just a thought.
Thanks. We don't know that states are super relevant relative to markets. We forecast for, not sure that can forecast for New York State is driven by New York City, right? If we forecast something for New York State, it's not going to be relevant to every market in New York State. Albany is going to be far less relevant than New York City, which accounts for, call it, 70% of all the hotel rooms in New York State. So I appreciate the thought, but we don't ever get the question for forecasting by state.
With the cost of construction increasing, as alluded by your presentation, a decent rate of return on investment is going to be challenging. What are your views? Why would hotel owners build more? 100 RevPAR today doesn't give you much returns.
I agree. I think it's a challenge. We think that wage growth is a huge factor and expense growth is a really big factor right now in terms of value appreciation. I'm not sure if I'm a developer, I'm super keen on developing in the current environment, which is one of the reasons why supply growth is at such a low level, and we think it's going to stay at a low level for several years. I think are going to be unique opportunities that make sense and that pencil out, and there will be developers that stretch and push to try to make something pencil out when it shouldn't. And those are the deals that are going to get done. But by and large, we don't see a lot of it.
How much risk is there in the World Cup next year not giving the performance bump you're referring to, given the trends occurring at this summer's competition?
Yeah, I think there's risk. But at the end of the day, I think there's still there will still be some demand. And more importantly, when we think about the World Cup, it's not actually about occupancy so much. If we go back to our forecast for those summer months, it's not about occupancy. It's all about ADR. Oops, it's right here, right? We've got relatively muted occupancy. 2Q's flat, 3Q's got some positivity. But these numbers are really tied to ADR growth. That's where we expect to see the strength. And if you look at kind of how things unfolded, that's exactly what we saw here, where in Russia, 7% impact was entirely driven by ADR. So it's less about the demand and more about the willingness to push ADR, which we think the industry will do.
Seattle has bounced back nicely, and San Francisco is now on investors' radars again. What do you think are the long-term prospects for investment in LA hotels?
I think investment in markets that have political risk and high and bad cost structure slash high wage growth are challenging. It's hard to be super excited about them. I can tell you from a San Francisco perspective, we think San Francisco fundamentals relative to 2024 are going to be strong. This year is going to be a great year for RevPAR growth. Next few years will probably be really strong from a RevPAR growth perspective, but the cost structure is still really challenging. Wage growth is still really challenging. The political risk is very much there, and that makes me cautious there. And when you think about LA, again, top line, you've got Super Bowl coming back, you've got the World Cup, and you have the Super Bowl, and you have the Summer Olympics. Great special events, but when you look at wage growth growing, from $18 to $30 an hour on the minimum wage dynamic, that is, that is a tough, tough pill to swallow, and it's hard to imagine that you're going to see um, value appreciation and cash flow growth even at high rates on the top line. So from our perspective, I think that LA and San Francisco are really, really tough. Seattle's a market that we think is a little bit more nuanced, where we like it. We really liked it over the past couple of years. For those of you that have been tuning into our webinar 2 years ago, we were pounding the table on how strong Seattle was going to be. Um, we still like Seattle, but it's now more middle of the road than it was a couple of years ago, where you've got good top line growth. It doesn't have the same risks that we see in San Francisco and LA, but has some of them, which is why we've seen some of pullback in terms of our outlook for Seattle.
All right, and for right now, oh, there's two more questions.
Okay,
With
great.
now three. With Austin's convention center closing, which convention centers or cities are going to be best positioned to benefit from Austin's displacement?
Great question. I think the beauty of this is that's already happened. Convention bookings tend to be booked years in advance, and we have the convention pacing data for every major convention center across the country. And we built that into our data, and you can kind of see it through it. Some of that in 2025, we kind of highlight. We think Denver's been a big beneficiary, which has some pretty strong convention pacing metrics over the next few years. You won't see so much in Dallas. Houston's not really seeing as much. San Antonio's doing okay. But it really does, you're not necessarily, it's hard to break it down specific to saying, hey, this is positive from San Antonio. Oops. There we go. This is positive from, demand tied directly to the Austin Convention Center, but we generally know which convention centers are outperforming and which ones are underperforming.
Do you think the World Cup will have a positive impact occupancy ADR for the following years for those markets hosting it? Have countries, markets that have hosted the World Cup in previous years experienced increase in demand?
Generally speaking, it tends to be more of a one-hit wonder. We don't see a big uptick in demand down the road following major special events. Kind of like a Super Bowl doesn't translate into more demand in, March, April, May following the Super Bowl. So it's kind of more that during the events themselves.
All right, and for right now, this is the last question. With private equity not investing as much as usual, what changes, if any, do you believe we'll see in market investing?
Yeah, I think that the big question is the macro outlook. I think private equity's done a big pullback because of the macro uncertainty. The challenges that we're seeing across the macro environment really weigh on fundamentals and value appreciation. I think that if we enter a recession later this year, when we come out of it, you'll see private equity get much more aggressive. I think we generally see big private equity not necessarily trying to market time a bottom, but trying to understand, hey, we are in the bottom 25% of this cycle, so this looks good. And I think that will play out, one way or another over the next couple of years. Either we've got a strong path to growth because the economy is doing much better, or we're coming out of a recession. So our view is you'll start to see some of those things shift over the next, call it, 18 to 24 months.
All right, and one more question. Do you think there are do you think there are operational changes like housekeeping service every other day that aren't being utilized that can lower expenses and help the bottom line, or are owners tapped out?
Oh boy. Oh, now you're going to get me on a soapbox. Yes, I think there are all kinds of operational efficiencies that could help the bottom line. And I would strongly encourage owners and operators to try to think about how they can better leverage technology, and not even new technology from 15 years ago, right? It seems crazy to me that we still don't use some technological innovations from 15, 20 years ago to help clean hotel rooms or other things. It's beyond my understanding. I don't think anybody is really excited to go to a Fairfield Inn and check in with a guest service agent. Give them a kiosk, right? How many of you, when you go to the airport, are, boy, I can't wait to talk to the guest service agent at Delta or United. You just want to go to your kiosk, get your boarding pass, and move on. Assuming you even have to get a boarding pass. Well, geez, I can just like get it from my phone and bypass it altogether, right? Even better. I think that at the end of the day, there are a lot of ways that we can increase efficiencies from a hotel perspective, which can cut labor. But none of this technology is new, but we still don't use it. At some point, it's going to have to happen because the margins are going to continue to erode unless we do. But with that,
We did get one more
okay,
question.
one more.
So, regarding the extended stay sector and some brands flags, more so operating as transient hotels with kitchens. Can you expand on this and share who some of the sector leaders are with the longest length of stay? Also, do you think loyalty programs and traditional amenities, breakfast, daily housekeeping, play a significant factor for this guest segment?
Um, Okay, let's start with the first part of that. So when you think about extended stay, if you're focused on some of the large brands, think about the Marriott and Hiltons. And I use this example all the time. When was the last time you saw a Ritz-Carlton commercial, Renaissance Hotels commercial, Delta Hotels commercial, Autograph Hotels commercial, Courtyard by Marriott commercial, Residence Inn commercial, Hilton Garden Inn, Hyatt Place, Hilton, Conrad, Waldorf Astoria, Grand Hyatt, right? You name it. The individual brands today are not what you're seeing marketed. Instead, it is the loyalty programs. It's Marriott Bonvoy, it's Hilton Honors, you name it. So at the end of the day, what you're trying to sell to your guest is not the brand, it's the loyalty program. And the same guest for the same loyalty program will stay at any hotel across the spectrum as long as they're getting their points. Maybe they have their preferences based on certain amenities at one brand versus another, but the points are the big factor. As a result, what you generally see across those large brands are transient-oriented hotels, regardless of whether they are extended stay or not. I think the one big exception today is probably Woodspring Suites, which is at the economy class within from Choice Hotels, where it's less about that. Plus, they started as a value place before Choice bought them. I think Waterwalk is probably another great example of something that's true extended stay, stay APTS. Another one that's true extended stay. There certainly are extended stay oriented product out there, but majority of the hotels that are in existence today, catering, quote, catering to extended stay tends to be more length of stay, transient oriented. If you're part of the big brand families, we'll see ultimately how some of the new brands like Studio Res and Live Smart and Hyatt Studios really become. It's too early to tell with not having hotels open yet or only one or two open across those brands. But that remains to be seen. But generally speaking, we don't see it.
And that's
All
the
right.
last question.
All right, everybody. Thank you for tuning in. For those of you that stuck around to the end, we appreciate it. Hope you found the information helpful. If you have questions or need anything from us, please don't hesitate to reach out and have a wonderful day.